Hello everyone out there. I'm Iza Hamid. I'm going to discuss question for MFRS 140 investment property. Question is from commenters October 2019 of FAR320 question 3. And we're going to discuss the suggested solution to that question. Let's start. Okay, question 3A lists 3 examples of properties that are not considered as investment property according to MFRS 140. So investment property, not investment property, but what are not considered as investment property. Okay, let's look at the solution. Solution 3A. Properties that are not considered as investment properties according to MFRS 140. So meaning that these are not IP. The property which are held for sale in the normal ordinary course of business. And it is relating to, for example, you have a developer they are building and constructing buildings, and at the end they are selling that as their principal business activities, or their so-called ordinary course of business. So this is under the FARS 102 inventory, therefore it is not an IP. Second one, a property that is currently owner-occupied. Okay, owner-occupied property is not an IP. It is under MFRS 116, which is also under PPE, and that is also the same case for future property to be used as owner-occupied. Third one, property that is leased to another entity under a finance lease arrangement. So property under finance lease arrangement is not an IP. However, if you have a property that is being leased out under an operating lease arrangement, that is an IP. The fourth one is about property that are currently under construction. So properties that are currently under construction or being developed or on behalf of a third party. So that one is also not an IP. Okay, I hope that makes it clear. We go to the next question, part 3B. This is about Shazmira, a fast food processing company in Kuala Terengganu, acquired. So it was not constructed, it was acquired. So it acquired a building for 75.5 million, and that is this purchase price on 1st of January 2016. Legal and other directly attributable expenses amounted to 12 million. So these 12 million are directly attributable costs, and directly attributable costs will be added to the purchase price to arrive at the initial cost. So therefore, initial cost would be 87.5 million. So that is the one that you must initially recognize and record as at 1st of January 2016. The building has 20 floors, okay, 20 floors. This is multi-level, multi-floor building. And out of that 20 floors, 18 of the floors are rented out. So meaning that that is being held for a rental purpose, which is under MFRS 140, and that will generate an income, rental income of 150,000 per month. So if it's 150,000 per month, so per year, you will have to calculate, right? So it will be around, you need to calculate that, right? And 2 floors are used as its headquarters. The floors of the building cannot be sold off separately. So this is a building that you call as a building with mixed use, or building with dual purpose or dual use, where parts of the building, here it is 18th floor, it was used to be rented out, and the remaining 2 floors are used as headquarters. So you are going to account for it separately only if the building can be sold off separately. However, if the building cannot be sold off separately or cannot be leased out separately, FAR270 prescribed that you need to look at the owner-occupied portion. In our case, our owner-occupied portion is 2 out of the 20 floors, which is not significant. So therefore, if the owner-occupied portion is insignificant, the whole building, which refers to the 20 floors building, will be accounted for as an investment property. The reason, because it cannot be sold off separately. So you cannot account for these 2 floors and 18 floors separately under different MFRS. So it should be under the same MFRS 140, and that is an IP. The fair value of the building as at the 1st of December 2016 and 2017. 2016 is 90 million. 2017 is 95 million, respectively. As of January 2019, Shahmira decided to convert the investment property to owner-occupied property. So there's a transfer actually here from the usage as an IP that was held for rental significantly, and that is now being converted, or there's a change in use of the building to be an owner-occupied property. The fair value on that date, which is on 1st of January 2019, was 98 million. The company adopts the fair value model. Okay, the impact of the fair value model will be for this fair value assessment that took place on 31st of December 2016 and 2017. Following the fair value model on subsequent measurement, right, for the IP, there is no depreciation to be provided. There is also no impairment test to be conducted. However, the fair value changes will be reflected to look at whether there is a gain or loss on the fair value change, right? So under the fair value model, the carrying value and the fair value as on the date of assessment or fair value assessment will be compared. So it will be compared once here, another one here. So we'll see whether there's a gain or loss. So, however, for the property, plant and equipment, they will adopt cost model. This will be true by the time the investment property is converted into PPE. But as long as it is an IP, it will be using the fair value model. Now you're asked to discuss. When you're asked to discuss the accounting treatment, don't give just the journal entry. You need to write the sentences with the focus on explaining the accounting treatment, starting from the classification, in that which MFRS apply, and then looking at the recognition, whether the recognition or it is under which MFRS, recognition as IP, SPP, the initial measurement, how much is the amount, and lastly is the subsequent measurement, whether they use cost model or fair value model. And at the end, you need to look at the impact of that in the presentation, which is in the SOPL and SOPL. That is to be done in 2016 and 2017 for 6 months. Let's look at the planning before you start writing your answer. First is for you to draw a time diagram. Put the date of acquisition and put the amount or the initial cost. That was 87.5. You can check the workings here. As on 31st of December 2016, from the information you are given that the fair value is 90 million. That is after a year. Following next year, which is after the first fair value assessment, the second fair value assessment is after another year. So that was at 95 million. So you need to look at whether there is a fair value gain or loss here, of fair value of or gain or loss here. Bear in mind there is no depreciation or impairment in 2016 as well as in 2017. We will now start compare the fair value as on the date of a fair value assessment here, and you will compare with the carrying value as on this date, 31st of December 2016. Since the cost is 87.5 and you are using the fair value model, so the carrying amount here will be the cost here. So therefore, you put here the carrying value and you will compare, you get that the fair value is greater than the carrying amount by 2.5 million. And that 2.5 million will be credited as an income in the SOPO and debited to the investment property. It shouldn't be reported as part of other comprehensive income. It must not be reported as a surplus on revaluation in the ARR. That is totally not acceptable and wrong because that one is a revaluation model under Mfrs 116. Next, you will compare the second fair value assessment here, comparing the 95 million fair value and checking at what is the carrying amount here or the carrying value here. Carrying value here would be the previous fair value. So therefore, the deemed carrying value as on 31st of December 2017 will be the previous carrying value of the investment. By comparing that, you have a gain, 5 million. That gain is to be credited again to the so that arrow pointing up is showing a gain. So if there is a loss, it will be a downward arrow. After you have made that planning, you can now write what should be in your accounting treatment. Start with what happened at the beginning of the year because you are asked to explain what happened in 2016. So it shall be classified as investment property since it is being rented out at market rental. So not only that is the thing that you should highlight. Since this question is about property that cannot be sold off separately, so you need to explain why it is still an IP. In addition, only an insignificant portion. When you say insignificant portion, show what is the portion, which is 2 out of the 20 floors, is used for headquarters. Used as headquarters or used for admin purpose, used for office or turned into an office, that is an owner-occupied property. For supply of service, for supply of goods, those are all under owner-occupied property. And the floors of the building, however, cannot be sold off separately because the building cannot be sold or leased out separately. Therefore, the whole building, thus the property which refers to the 20 floors of all the property in total, will be recognized as an IP as at 1st of January 2016 at 87.5 initial cost. So the workings here. Next is to explain what happened at the end of the year on subsequent measurement on 31st of December 2016, where we were going to compare the fair value with the carrying value, and the difference will result in a fair value gain of investment property, and that will be 2.5 million. How do you get 2.5 million? 90 million minus 87.5. So because fair value are greater than the carrying value, there is a gain. And this gain will be accounted for as part of other income in the software for 2016. So the statement is important. No depreciation is provided for the property since Chasmira has adopted fair value model. No depreciation and no impairment. As at 31st of December, this is what happened. The end of the year, the investment is carried at its fair value. So the carrying amount will be at fair value of 90 million, and these will be shown in the statement of financial position. Next. We move on to look at accounting treatment for the investment property in 2017. Remember, beginning of the year, the carrying amount, if we talk about beginning of the year, 1st of January 2017, the carrying amount will still be 90 million because no depreciation. However, on the 1st of December 2017, the difference between the fair value and carrying value, which will result in a fair value gain because fair value 95 is more than the carrying value 90 million. So that is 5 million of fair value gain. And that fair value gain will be accounted for as a gain or other income in the statement of profit or loss for 2017. There is no depreciation to be provided for the property since Shazmira has adopted the fair value model. Therefore, as on 31st of December 2017, the investment property is carried at fair value of 95 million. And this 95 million is the figure that you will show in your statement of financial position and non-current assets. That's it for question 3B. We move on to question 3B2. That one was B1. Now is B2. So B2 is focusing on the last bit of the paragraph. Yeah, a last paragraph, which is paragraph before the requirement. So this one is what was asked. Discuss the theoretical concept of the transfer of the building from P to owner-occupied property, aka PPE, as at 1st of June 2019, with reference to the MFRS 140. Meaning that you just need to discuss what are the guidelines on the MFRS 140 pertaining to the transfer as on the date of transfers. So they will convert the IP to an owner-occupied property. The fair value was 98 million. Remember, IP was using fair value model, and when it is converted into a PPE, right, they will start adopting costs. Okay, the last part of the question, what you need to write is mention about the building that was accounted initially SIP in accordance with MFRS 140 when it was first acquired on 1st of January 2016 at 87.5 million. Second part is straight away talk about 1st January 2019, where there is a transfer from IP to PPE, as there is a change in the use of building. So the change in the use of building from IP was it was being held for rental, owner-occupied property, which is actually a PPE. Thus, it will be accounted for as an owner-occupied property when, from 1st of January 2019 onwards, you need to close the book where that is recording IP, and whatever transaction that will confirm or will be related to that particular building now will now be no longer an IP, but it will be a PPE. Thus, it will be accounted for as a PPE, recognized as PPE, in accordance with MFRS 116 beginning 1st of January 2019 onwards. And therefore, the deemed cost of the PPE, meaning that the cost of the PPE on the date of conversion shall be the previous fair value of the IP. Remember, IP was assessed at a fair value of 98 million on the date of conversion. So 1st of January 2019, the deemed cost of the PPE shall be the previous fair value of IP of 98 million. And that's it. I hope you have learned a lot from this session. Thank you for watching. I'll see you when I will see you. Assalamu alaikum wa rahmatullahi wa barakatuh.